SoFi has been fighting with one arm and both legs tied behind their back. I think it's a coin flip the company even stayed in business through all this. And to see them absolutely hitting these doubles and triples every ER in this controlled manner is just inspires so much confidence in management. Guys, I just love the company. I love the stock. I'm more bullish than I was when I came on the beginning of this podcast.
SoFi and the rest of the fintech companies have had quite a large run-up. This was mainly due to one very exciting FOMC meeting, which boded very well for the idea of rate cuts. But Stephen, why is that important? Why would a company like SoFi benefit?
The very short version of what happened is our wonderful chairman, Jerome Powell, and the rest of the cohort of the Fed saved the holiday season. They did not say that they are cutting in March. Let's be very clear. They did not say that.
Correct.
What they said is unemployment came down, growth is slowing, the door is open for another hike. The consensus is that rates will end up at 4.6% in 2024, 3.6% in 2025, and 2.9% in 2026. If the Fed stays on those targets, is a completely different story. But they're basically baking in 75 basis points worth of cuts in 2024. And based on what they have currently done, logically it would seem there would be 3 25 basis point cuts at some point. They could go up in the short term, but even if they were to go up at the January meeting, it would be short-lived. It would either be at 60 or 120 days. If we go to Fed Watch tool, we can bring up the probabilities. I'm sure they have been moving quite a bit since the meeting. Now, it's important for a number of reasons. First reason is cost of capital becomes cheaper. Businesses are more likely to expand. Businesses and individuals are more likely to make big purchases when rates come down because financing is going to be much cheaper. Cost of capital coming down, business expansion means more money going to a lot of publicly traded companies for goods and services, in addition to individuals getting more jobs, which will bring unemployment down and employment up. All good things for the economy. It's a sign that the economy is going to be strong. The number one indicator of a recession is unemployment. When unemployment historically since 1948 goes up by 1% or more, we tend to go right into a recession, or the unemployment increases into a recession. Unemployment dropped 0.2% last month. We need another month or two's data to see if this was an anomaly or if this is a new trend that's establishing. Unemployment was, I think, it was either 3.4 or 3.5% in June. It went up to 3.9% in October. Now it's down to 3.7%. Unemployment has been under 4% for a fairly long time historically. Things are looking very good right now. If unemployment starts to go up, the Fed could have to react quicker and bring rates down. Things still need to play out. Like, there's no guarantee that rates are going to be cut in March, and Jerome Powell certainly did not say that or insinuate that. But it is very bullish for the market going forward, and one of the biggest reasons that's overlooked, and it's helping SoFi right now, even though SoFi's exposure may not be as much as other companies, it's more for the regionals. You have roughly 1.7 trillion coming due in 2024 and 2025 on commercial real estate assets. The regional banks are the largest lenders in that cohort of debt. The big fear when the Silicon Valley Bank crisis happened in March or April was that rates were going to be higher for longer. Commercial real estate companies, REITs, private ventures, whatever you want to call it, would not be able to pay their bills. They wouldn't be able to pay their debts. The profit models that they built would be useless because they did in a rate environment that was so low that it wouldn't work. They would have to hand the keys back to the bank. When the bank would take these assets on, the fear was that they'd be taking on unwanted assets that they have no proficiency in running. They would have to sell them for pennies on the dollar and recognize large losses on their books, which would bring their book value down and basically really hurt them, possibly cause some of them to go under, depending on how underwater the loans were. With the commentary out of the Fed, this looks like less of a problem now, because as rates come down, with that debt being maturing over the next 2 years and rates coming down, it's much less of a problem than it was 2 months ago.
Right.
So that made the financials rally pretty hard. And SoFi is getting a tailwind from that because it is grouped into the financial sector, because you can say that when carrying costs for credit cards and everything else comes down, it's easier for people to pay back money. So you could have less loans going into default, et cetera, et cetera. So it is a positive for SoFi.
All small caps ran high growth names, high risk names as the market was going more risk on. The Fed holding rates where they were, even though Powell was more hawkish earlier on in the year, he needed to project that hawkishness. But it basically confirmed, okay, we're not going to get any more hikes. That would be silly. And we know the Fed sort of hiked even more than they probably should have with the limited data they had available. The bigger validation for the market was really those cuts, this consensus around us having 3 to 4 cuts in the new year to essentially bring rates down to that mid 4% range. But this sort of paints a pretty clear picture how those rates might play out over the next 2 years. And that really just gives the market more permission to go risk on and make a strong argument that they're going to be able to capitalize more on returns in equities as opposed to returns in treasuries over the new year. And that's why, I mean, SoFi, it might have gotten a tailwind from financials, sure, but it definitely got a tailwind from having a high growth multiple, because all high growth names essentially in a lower rate environment are going to see a lot of that capital that's flooding back into the markets.
Yeah, I mean, and I was shocked that it grew. So December 7th, when the new numbers came out, and it jumped from 5.7 trillion to 6.1 trillion sitting in money market accounts. Now, let's be very clear. Money sitting in money market accounts is so much different than money that is in CDs or T-bills, because CDs and T-bills are a fixed amount of time duration. You get penalized if you need to touch that money. A money market account is completely liquid. You can move that money at a moment's notice. So when you have 6.1 trillion sitting in money market accounts, that's money. These investors move there to generate yield because they're unsure or they want income, but they don't want it bad enough to lock it up at a fixed duration. So you got to believe that a decent amount of that's coming back into the market when the Fed starts cutting rates and the yield on the money market accounts come down. And if they're just hanging out in money market accounts, and this is my own personal thesis, when this money comes into the market, I think it's going to do two things. It's going to go into income producing assets, dividend stocks, probably dividend aristocrats and dividend kings will get a bid. I think REITs will get a bid. But I also think they're going to look for high beta and they're going to look for growth companies, do a catch-up trade. I don't think the money's going into Amazon or Google for a catch-up trade. I think it's going to go into SoFi, Robinhood, that type of stuff for a catch-up trade, because they're going to want to close the gap. And I don't think you're going to get that from big tech. I do think a sector rotation is going to occur into other areas, and we're going to see a broad rebound in the markets, because there were a lot of areas that did not necessarily do well or certainly did not keep up with tech. I do think tech is going to have a good year next year. I just don't think it's going to replicate 2023. I do think you're going to see double-digit increases in these names, but certainly not what we saw this year. I think that you're going to see a lot of these other sectors catch up, and these growth companies could definitely see capital come in, because I think people are going to look for the most bang for the buck on it.
Well, I think that there's a super drought right now in some of the small to mid-sized cap stocks, and that there will be a rebalancing back to normal, which will lead to outperformance in some of the smaller names. But I don't just want my opinion on this. Ladies and gentlemen, I'd like to introduce you to Danny Deals. Danny.
Hello, everybody. Hello and welcome. Welcome and hello and welcome. Thank you for having me on. Tannor, it's an honor. Steve, an honor to meet you. And Tevis,
Nice
an
to
honor
meet
as
you.
well.
What did you think about the latest meeting? Why do you think that this is such a large impact to SoFi? Do you have any predictions, expectations? What did you think over the last couple of days?
I'm more bullish SoFi than ever. The entire bear case that the likes of the Chia Pet and the Five Head from Compass Point assembled against SoFi all relied on this theory that we're going to have a giant recession and it's higher for longer. And even though SoFi's borrowers are of extremely high quality, they're eventually going to start to default, and they're sharing the risk on these, gain of sale agreements with the likes of BlackRock and these other organizations. They're laying off some of this loan. It's such a small, when I hear about the bear case, it's loans and it's macro. Okay, 90% of the bear case just fell apart. I mean, what is SoFi doing poorly? I saw you talking about the credit cards. That's a legitimate issue. I mean, I'd be the first to say there are legitimate issues that SoFi has to address. But if you take an honest, holistic view of what this company has accomplished, and the management and the business model, and the fact that the business model has not even had the opportunity to work. They hit us with COVID, they reinvent the entire business, grow at a very steady, controlled rate. I'm sure you guys know how hard that is. You see companies like Affirm and Robinhood, they're all over the map. SoFi is just dialed in. Noto's a finance guy. The guy inspires confidence. As far as the macro goes, why is it so important for SoFi? There's a massive short on the stock, 144 million shares. And that entire short is based on smoke and mirrors, hints, innuendo, and things left unsaid.
So let me pick up on something you said, because it was a piece of news this week and I'd love for us to chat about it. We got the short interest, the highest it's pretty much ever been on an aggregate basis, 143 million shares sold short as of November 30th.
It's 142.65 million right now.
It's like
14.85%, I think.
14.6% of the shares are sold short and 15.5% of the free float.
This came out on December 12th, and interestingly, SoFi rallied like 20% after this news because of the FOMC meeting. I mean, this is going into the quarter that's going to be the tipping point from a profitability perspective and expected forward guidance for full profitability from this point onward, sustainably profitable. And yet we're still increasing in the level of short interest. Is it just people think we're trading in a channel and we're going to fall back down to 6? Or like what is the thought process?
Being so fundamentally driven, not following a lot of technicals, I find it hard to believe in some of these channels. The channels work until they don't. I don't think that we just continue to go back down to 6 and up to 9 and have this cycle continue while breaking into new milestones, permanent contribution profits, net income going forward, potentially 4 quarters of profitability going forward. This changes the way companies look at this stock, not even just retail investors, but institutional investors. That's the people that really need to start pouring into SoFi. It's not retail that we have to convince. 25% of this company is owned by institutions. If you compare that to any other bank or fintech or anything like that, it's so unbelievably low for the sector.
Yeah, but there's a lot of reasons why that is also. It needs to get certain metrics, and then you're going to see institutional ownership increase drastically because it'll meet the criteria to be part of specific funds that have the largest amount of AUM.
Even then, look at the S&P 500 inclusion effect. Doesn't make the stock double. It's an increase in the stock and potentially on a permanent basis whenever you get included into these funds, but it doesn't double your market cap. The effect is real.
But it helps with short attacks, certainly.
Do you actually think that a short squeeze is possible in a stock like this?
Yes. This is what I wanted to also touch on, because Chris Hager, I think, made a post on X saying that the liquidity of SoFi is so high to the point where a 15% short interest is not enough to trigger a squeeze. I personally think that there could be a squeeze for sure.
It doesn't matter if it's 5%, 10%, 15%, or 30%. What matters is if the shorts are underwater and if it looks like their short position is going to close out underwater, because they will lose less money if they buy it out and close it before the expiration date. So it matters what the average short got in at, where the stock is now. Hypothetically, let's say they're down now. SoFi is going to report end of January. I would say that there's probably a low probability that SoFi is going back to 7 before earnings, especially with the news that we just got out. If people were shorting this stock at 850 or so, they're going to have to cover. Yeah, they can roll the dice, but going into a quarter where SoFi has not warned that they're going to miss profitability, it probably wouldn't be the best idea to hold a short into this earnings if you're underwater going into the earnings. So you could certainly see a short squeeze.
Yeah, and in fact, management has doubled and tripled down on the idea that they're going to be profitable this quarter. They had a meeting this month talking about how they're going to be profitable in Q4. I don't think they're going to miss it.
So basically, if I can summarize, Steve, you think that there's basically a deadline up until shorts need to cover Otherwise, profitability is such a done deal at this point, and a rally is so guaranteed from profitability, regardless of how priced in it is, that it would spell a bad time for shorts if they don't cover by that time.
Yeah, I mean, look, there's two ways to short. You borrow shares in a short, or you can buy puts. And puts roll off every week with this company because there's
Right.
weekly option chains. Depending on what price you purchase your short at or what the target price is and the spread between it, and if you're up or down. I mean, look, if people went on a very long short to maximize the delta between the two, there's a halfway decent chance that they're underwater right now. What did it run to last earnings? 11 or 12? People may have started shorting that. You're starting to get back to 11. If SoFi runs up to 11 in the second week of January and it doesn't come back down and you're going into earnings, people are going to close out their short positions because if it goes to 13 or 14, they're going to owe the difference. So people are probably going to cover in those scenarios.
There was always a sort of core short on SoFi, 70, 80, 90 million shares. But if you look at the short interest, it actually went from 90 million to 160 million shares on loan after the pump and dump, after the stock went up into the 11s. Like a lot of these guys were shorting extremely heavily at 720, 740. I mean, there was days where they were borrowing 8, 10 million shares, I think expecting to drive the stock back down under 6. I think they were expecting a really bad earnings report driven by the macro, driven by defaults. And I think they got a huge October surprise. And now I just think they're completely trapped. I don't think they have an exit strategy. I think the smart shorts who were long term would have covered down in the 4s. I mean, you're going for absolute zero. I think now you're in the, you're in the mid 9s. And I think a lot of the shorts are deep underwater at this time.
This is not a good company to short because the littlest news.
Let me ask you guys this. So if I did a 20% run this week, what percentage of those shorts would have already covered at this point?
Nobody covered. None.
Hard to tell, right? You don't know if people are doubling down. As a percentage of outstanding shares, the percentage of shares continues to go up. Like it's at all-time highs now. Either they get buried or they really think SoFi is going to get trapped. I don't know what their decision will be.
I mean, what doesn't make sense is we were down to almost 12% being short September 15th, and we're back to over 16%.
Yesterday, they returned 7 million shares at the beginning of the day. It looked like there was just going to be this wholesale covering. And then after hours, they borrowed the 7 million shares back. As far as I can tell, I look at probably 3 or 4 of the most prevalent sites that you can pay a membership to and look at as updated as they can get the short interest. They are showing nothing return. If anything, the shorts increasing into this rally. There's been no covering. At least that shows up on anything I subscribe to.
Which does open the door for a very real possibility of a short squeeze if nobody's covered so far.
Yeah.
In which case, what is the corresponding price if this does go into a short squeeze situation?
You got 16% of the float short. To close it out, they got to buy the shares. So that's just more liquidity going into the stock. If you even get anywhere close to half of these covering, in addition to other people buying, this could 12, 13 going into earnings maybe.
Hit your end of year price target, Steve?
Look, I don't think it's going to get
15, by the
there.
way.
I really did in the beginning when we hit 10 over the summer. Look, I think that SoFi is going to have a really good year next year because I think a lot of things are going to go right at the same time for the first time ever in the company's history. And I think we're going to have a very good year next year. I could be wrong, but unless something goes really wrong, there's a lot to be bullish about going forward.
SoFi's business model is going to start to work well as rates come down.
Yes.
I mean, we own the student loan refi market. Those borrowers have money. They have great careers. They're young. They're only going to be making more money over time. They have average 785 FICO scores. Their scores are even far higher than other SoFi borrowers. So we already own 60% of that market. Discover just announced they're abandoning ship because, they can't make a go of it. They're weak-kneed, paper-handed fools. People don't want the business because it doesn't have a great margin. But our business model is just come on in the door, welcome
Yeah.
and hello. And now we can sell you 5 other things because these are upwardly mobile people with PhDs and law degrees and MDs. And this is just absolute gold mine long term for SoFi. Noto is so many moves ahead. He's ahead of the Fed. He's ahead of all these other executives. SoFi has been fighting with one arm and both legs tied behind their back. I think it's a coin flip the company even stayed in business through all this. And to see them absolutely hitting these doubles and triples every ER in this controlled manner is just inspires so much confidence in management. Guys, I just love the company. I love the stock. I'm more bullish than I was when I came on the beginning of this podcast.
Chris Hager pointed out something recently on Twitter where he said he believes some of these analyst predictions on revenue growth rates throughout the next couple of years are drastically too low. They're expecting decreases in revenue over time, but very early. But you're talking about comparing a company that was growing in stronger growth rates back with not having some of their business models there, not having a bank charter before.
The 19-20% 5-year CAGR is, I think Noto made up that number. So when he hits like 28, 29, he's just going to look like an absolutely perfectly haired genius. Our growth should be accelerating. We have the Super Bowl again in 27. They're talking about adding 1 million new members per quarter. So why would growth decelerate that quickly in the near term? I really think CAGR will be over 25.
It does sound as though management is giving these hints through these little statements like 2024, 2025, we're aiming for 800 to 1 million plus per quarter. And you can extrapolate from that to say over 4 million a year. And then to say, well, our revenue mix is going to be closer to 50% lending and 50% everything else, or 30, 30, 30. And then you can extrapolate from that to say, okay, what is lending? Let me add a growth multiple to lending, 20%. What does technology platform and financial services need to be to even make up that percentage in the revenue mix? And you can get to some crazy numbers just by doing these exercises of reading between the lines of what executives have been saying. But I don't think a lot of people are doing that.
If you start to do that kind of math with SoFi and you make certain assumptions about Galileo gaining market share, this valuation under 10 billion, when you really look at what this company is and can be, I've heard Steve talk a lot about top 10 financial institution. In today's dollars, 130 billions. By the time they get there in 12 years, we're probably talking about a company worth $300 billion. I think Galileo is going to be spun off and is going to be more valuable than SoFi. Sorry,
Please don't say that.
No, bad news.
The synergies between them and Technesis make something so unique that there's nobody that I found in the rest of the industry that has the capability that joint venture has. But if it's spun off, SoFi won't get all that revenue, and then their tech multiple goes out the door. The whole allure for SoFi being a hybrid company plays around the tech platform. Otherwise, without that aspect, they are a similar financial institution to a lot of these other companies, which is not a bad thing. But this is their ace in the hole because they have the potential to generate the back end for their competitors and generate reoccurring revenue from that and make a case of why SoFi should be valued in between a financial institution and a tech company.
I also with regards to Galileo and SoFi, the pure, SoFi core business, I do think that to some degree, there has to be the separation of church and state, because Galileo is going to go after the major financial institutions, and the closer that they are to SoFi, the financial entity, that's essentially a competitor of these financial institutions. We already know Galileo has, large financial institution clients. We don't know any of the names of these clients. They are reluctant to even say that they're working with Galileo. Their reluctance would be even higher if Galileo was even closer to SoFi.
That's why I thought they would spin off the company, is because as SoFi gets larger and larger, their competitors are not going to want to, feed them dollars. I think that's just my theory, but I think it's definitely correct that there is a great deal of synergy, and we haven't even we were told about the cost savings from Galileo that really kicks in next year and will start saving the company. I think it was at $80 million a year. And then that'll go up after 5 years. So I'm not mad at having Galileo be part of SoFi. I'm just saying intrinsically, I think people dramatically underestimate the value of Galileo. I think it would be an
Oh,
incredible
yes.
company on its own, and I'm very happy to have it remain part of SoFi. So
I think there's a third element to the Galileo Technisys piece that has not been fully ingrained yet, that will be a huge part of why it's important that they're with Galileo, and what separates them from everyone else is the bank charter. What makes Sutton Bank is that they will host a ton of deposits for fintech companies. That alone is another piece of the revenue pie. And I think what makes the trifecta for SoFi is you can go to some of these fintech companies, and this is not necessarily important for the large financial institutions, but it's important for the Chimes, for the, Robinhoods, for all these companies. You can go to them and say, hey, we'll set up your entire card program. We'll build all the UX, UI. We'll set up everything all in a modern cloud-based solution. And we'll also host the deposits and issue the cards ourselves. That's another piece of the pie. And I think that that's important. Separating away from SoFi, I don't know if that gets you that close of a relationship. I still think that the future of finance is in the fintechs, and everyone's talking about these large RFPs, which will bring us a lot of revenue to date. But I still believe that the neobanks and the tiny fintechs are where the clients are headed. We already have a massive portion of those clients. It's just a matter of them signing up those clients and making sure that Galileo doesn't lose any of them. Like what happened with Current, that can't happen again.
They build their walls around their castle, that is Galileo, much higher with every subsequent product addition that they add. They added Technisys into the Galileo mix. That all of a sudden creates a unique value proposition that builds a moat, right? They added all of these like buy now, pay later, the cards, the processing, the APIs, specifically all the news that we've been reporting on with regards to Galileo throughout this year has been, number one, we can only presume, but number one, requested by these large enterprise clients. And number two, builds a bigger and bigger moat around that product offering. And why is that important? Because it increases the barriers to entry so that we can prevent a Current in the future. They cannot leave the ecosystem in the future if Galileo and Technisys and all of these value offerings combined do something that nobody else in the market can.
I think Apex FinTech should become a part of the AWS of FinTech solution. So Apex Clearinghouse that everyone knows about, dealing in all the brokerages, account openings, global, multiple countries, hundreds of clients, doing all of the brokerage side of finance, the part that Galileo really hasn't touched yet, right? It's the weakest part of SoFi as well. So we could potentially look, and we already have acquired a percentage of that company already. 17% of Apex was already acquired by SoFi. So it's definitely in their wheelhouse. They think about it for sure. But the rest of that company could make, so then we could set up brokerage, set up accounts, set up the banking solution, set up everything. I think that literally would be a one-stop shop, AWS of FinTech. No one to date that I've heard has talked about that yet. And I think that would be unbelievable and well worth a merger.
Just before we go into an Apex rabbit hole, can we cover one more piece of news that we saw this week?
Yeah.
With regards to the SoFi at Work partnership, it's smaller, but I mean, we only have 6 minutes left.
Very important piece of news, because SoFi is going to break into that benefits.
Yep.
This is a really important story, Tevis.
SoFi at Work announced on Monday or Tuesday, I believe it was, a partnership with Kimley-Horn, this company that I'd never heard of before, but apparently they have 8,000 employees and over 100 offices, where essentially this company is offering their employees 8% of their salary plus bonus for student loan repayment. And so it's sort of this three-way partnership with Kimley-Horn, who is offering this benefit to their employees that is powered by SoFi at Work. And then the third prong is T. Rowe Price, who is the provider of these 401ks. And so essentially what's happening is, if I, as an employee at Kimley-Horn, pay off $2,000 in my student loan, SoFi at Work highlights how their verification system works, where basically it's going to detect that I have paid off a student loan, or I have paid off an amount towards my student loan. That's going to notify my employer, and my employer is going to match that amount in my 401k. So while I'm paying off my student loan,
a 200% match. So if you do a 4% contribution, they'll add 8% on top.
Right. So essentially the concept is, as I'm paying off my student loan, it's as though I am investing in my 401k as a result of this employee benefits program offered by
Yeah.
Kimley-Horn, which is really cool because it all hinges on SoFi at Work's ability to detect this repayment and essentially act as
This part here is the exciting part, is that this is now being allowed as of 2024,
right.
which evidently this student loan verification product is very new for SoFi. They recently just came out with this even after the moratorium had been resolved. So very recently. And now this is them coming to work already. And T. Rowe Price, which is kind of exciting that they're a part of this, they're also a client of Galileo's through the Waysaver program. They're creating an employee benefits card, right, through Waysaver. And it's also powered by Galileo. So you're seeing this a lot. They're doing this with Experian, where Experian is offering all of our insurance products and also a product or a client of Galileo. You're seeing it through T. Rowe Price. And I'm sure there's going to be tax programs or whatever that start coming out that have H&R a block coming up because that's a client of Galileo. Or I could see a card program from Expedia coming out that's also powered by Galileo, because they seemingly are, if I were to guess, giving preferred pricing to these clients.
Well, even with a SoFi and T. Rowe Price partnership, which I mean, T. Rowe Price highlights SoFi at Work on their website as well. Just that alone, the network effects are so large, and this benefit is so captivating for these employees because it knocks off, two birds with one stone, so to speak, that as it starts to ramp up more in 2024, it could become a really lucrative opportunity for growth for SoFi.
Ladies and gentlemen, thank you all so much for watching the SoFi Weekly Podcast. Danny Deals, thank you, my friend.
Thank you for having me on, guys. Really appreciate it.